Taxes. You worked all month. You flipped burgers, smiled at customers you hated, survived a grease fire, and finally payday arrives. $2,000, except your bank account says $1,456. Where did the rest go? Welcome to Taxes, the world's oldest subscription service you never signed up for but cannot cancel. The government takes a slice of everything. Income tax hits the money you earn. Sales tax hits the money you spend. Capital gains. Tax hits the money your investments made while you were literally sleeping. Social Security tax is the government forcing you to save for retirement whether you like it or not. Medicare tax helps keep older folks and seriously ill people covered. And filing your taxes is a special kind of chaos where the government already knows what you owe but makes you guess anyway. Get it right, fine. Get it wrong, enjoy your documentary. Countries with higher taxes generally have higher quality of life. Comforting information that arrives right after you see your pay stub. Banks. Most people imagine a bank as a giant vault with a dragon inside guarding your savings. Adorable. Wrong. The second you deposit your money, the bank hands most of it to a stranger who wants to buy a jet ski. This system is called fractional reserve banking, which works on the assumption that not everyone will show up demanding their money at the same time. Which was true until 2008, when everyone did exactly that, and the whole thing collapsed like a wet paper bag. Banks make money by lending your deposits out at higher interest rates than they pay you. You are the supply. The jet ski guy is the demand. The bank is just a very confident middleman. They entice you to keep your money there because cards are convenient. They technically pay you interest, and a bank is safer than your sock drawer. In the US, deposits are insured up to $250,000 per person, so your money is safe. The jet ski guy's money, however, is a different conversation entirely. Interest. You borrowed $1,000. You have to pay back $1,280. Why? Because money charges rent when it stays in someone else's hands. Simple interest is a flat fee. Compound interest is that flat fee having children, and those children also want rent. Miss a credit card payment at 20% interest, and suddenly your $12 burrito becomes a $50 regret with a late fee. On the flip side, invest at 7% annual compound interest and watch your money duplicate itself like a very slow magic trick. $100 becomes $200, then $400. Then you wake up old, wealthy, and insufferably smug at family dinners. Interest is either the engine of your wealth or the fire quietly burning down your finances. The difference is who's collecting it. Spoiler alert, try to be the collector. Inflation. You bought a bag of chips. You open it. Half the bag is air. You paid 30% more than last year for the privilege of eating sadness. That's inflation. Money slowly losing value over time, not dramatically, not with an announcement, just quietly shrinking your purchasing power while you're not paying attention. When too many people chase too few goods, prices climb. When supply chains hiccup, costs rise, and businesses pass that joy straight to your wallet. There's also expectation inflation, where people think prices will rise so they spend now, which causes prices to actually rise, making them right, making everyone worse off. A small amount of inflation, around 2% annually, is considered healthy. When it spikes, the government raises interest rates to make borrowing more expensive so people spend less. The economy cools. Your future vacation gets postponed indefinitely. Progress. Recessions. Things are fine. You have a job. You're planning a vacation. Maybe even a nice one. Then suddenly, layoffs. Stock markets in freefall. Everyone panic hoarding. A recession is when the economy shrinks for at least 2 consecutive quarters, and it turns out 2 quarters of collective suffering is enough to ruin most people's plans. Recessions happen because of high interest rates, global crises, or simply the economic cycle doing what it does. Boom, peak, collapse, rebuild. Think of the economy as a party. The boom phase is everyone dancing, drinks flowing, good music. Then someone checks their bank account. The DJ switches to sad music about corporate restructuring. Recessions aren't permanent. Governments cut interest rates, send stimulus, cross their fingers, and wait for people to buy overpriced coffee again. Eventually spending returns, businesses rebuild, and optimism crawls back. But recessions leave marks. Nobody comes out of a reset completely unchanged and financially unscathed. Credit scores. Somewhere in a server room, a shadowy algorithm knows your name, your history, and how many times you paid your credit card late during your early 20s. That information becomes a 3-digit number ranging from 300 to 850, and that number decides whether you get a mortgage, a car loan, or a soul-destroying 27% interest rate on a television. Below 580, lenders treat you like a walking liability. Above 750, doors open with a polite smile. Credit scores measure payment history, credit utilization, account age, credit mix, and recent applications. To improve it, pay on time before the late period kicks in. Think of your credit score like a pet. Ignore it and it ruins everything. Nurture it and one day it helps you buy a house. The genuinely frustrating part is you can have 0 debt and still have a terrible score just from having no credit history. Yes, the system is designed that way. No, nobody asked you. Currency and money. Here's something that will mildly ruin your evening. Money is not real. It is a shared agreement, A dollar bill has value because everyone agreed it does. A stick does not have value because nobody agreed it does. The philosophical gap between those two things is the entire foundation of civilization. Governments print money, central banks regulate how much exists, and people trade it for goods and services. Print too much and inflation turns your savings into monopoly money. Allow too little and nobody can afford anything. The system requires trust to function, and the fact that it mostly functions is genuinely impressive, given how often humans agree on nothing. A Bitcoin and a dollar bill have the same legitimacy in theory. One just has more people currently believing in it, for now. Investing. Inflation slowly eats your money if you leave it sitting around. Investing is the counterattack. Instead of trading your time for money, you trade money for more money with risk attached. You can buy stocks, tiny ownership slices in companies that grow or shrink based on the company's performance. You can buy bonds, essentially loaning money to governments or corporations in exchange for interest payments. You can invest in funds, which bundle stocks and bonds together so you're not betting everything on one company's quarterly report. Real estate means buying property and hoping someone pays you rent indefinitely. The key to investing is not being lucky. It is being early, diversified, and patient. Markets go up and down. The real danger is never starting and watching inflation quietly take what you worked for. The second scariest outcome is starting, panicking, and selling at the worst possible moment. Value. Pick up a rock. It's a rock worth essentially nothing. Now imagine that rock is rare, shiny, and yellow. Suddenly it's gold and worth a fortune. Nothing about the rock fundamentally changed except human perception. That's value. It isn't always logical, but it is always real in its consequences. Steve Jobs understood this. He created a device that millions of people considered indispensable, so they paid thousands of dollars for it without hesitation. Doctors and lawyers earn significant money because what they provide is difficult to replace and the stakes are high. Gucci sells a handbag made of similar materials to a $10 bag, but charges 100 times more because people perceive it as more valuable. So it is. Value doesn't have to be objectively real to generate real money. It just has to be believed, which is either inspiring or deeply unsettling depending on your afternoon. Time. The most valuable asset you own has nothing to do with your bank account. Almost everyone starts with a lot of it, but nobody gets an unlimited supply. Most people trade time directly for money at a fixed rate. 1 hour, one paycheck, forever, until retirement or burnout, whichever arrives first. The people earning the most have figured out how to make each hour generate disproportionate returns through skills, leverage, and systems that work while they sleep. In investing, time is the true engine, not intelligence, not luck, not connections, time. Because compound growth doesn't care how smart you are. It cares how long you let it run. Someone investing modest amounts consistently over 30 years will outperform someone investing large amounts over 10 years. The early and boring investor wins. The exciting late investor is still working. And if you've made it this far, that already puts you ahead of most people. So here's one bonus financial concept people tend to overlook. Budgeting. A budget is just a plan for your money before your money makes its own plan without you. Most people don't budget because they don't want to confront what they actually spend on things they don't need. A budget has one job. Tell every dollar where it goes instead of wondering where it went. A common framework is 50-30-20. 50% on needs like rent, food, and electricity. 30% on wants, which is the category that quietly destroys most budgets. 20% on savings and debt repayment. The beautiful thing about budgeting is it doesn't require earning more money. It requires knowing where your current money disappears. Most people, upon actually tracking spending for 1 month, discover a subscription they forgot about from 3 years ago, still charging them monthly. The service has since changed ownership twice. Nobody knows what it does anymore. If you like this video, I'm pretty sure you're going to like this next one too.